Last week, gold's price action left traders uncertain, as the metal swung unpredictably and defied expectations. Investors who usually rely on gold for stability found themselves second-guessing every move. Signals were mixed, with sharp intraday swings making it tough to predict direction. Some saw opportunity, others only risk. Despite a major geopolitical event, gold stalled below $3,500, forming a triple top, a bearish sign. Traders watched to see if resistance would hold. Safe haven demand clashed with a rising US dollar, creating a tug-of-war between buyers and sellers. MCX Gold. August futures dropped sharply midweek, confirming sellers' control and forcing traders to rethink strategies. Economic data added confusion, with soft US inflation and weak UK GDP offering no clear direction. Gold ended the week at a crossroads, leaving traders cautious and waiting for a clear breakout or breakdown. Geopolitical tensions in the Middle East, especially the Israel-Iran conflict, have become the main driver for gold. Investors are seeking safety, but the rally has been moderate, with prices struggling to break $3,500. While war risk supports gold, a strong US dollar and central bank signals are holding it back. The market is balancing fear of escalation with hopes for containment or diplomacy. Any further conflict could send gold soaring, but a sudden peace could trigger a sharp drop. Traders must watch headlines as closely as charts. The war premium is real but fragile. Gold's fate hinges on the next move in the Middle East. Fibonacci retracement is a key tool for gold traders, offering a structured way to anticipate where price might pause, reverse, or accelerate. By applying this tool, traders can gain a clearer perspective on the market's rhythm and identify areas where buying or selling pressure could emerge. It helps spot likely support and resistance zones, which are crucial for planning trades and managing risk. These zones act as psychological barriers, often attracting significant trading activity. After a big move, gold often retraces to key Fibonacci levels. These are not random but are based on mathematical ratios found in nature and financial markets. The most watched levels are 23.6%, 38.2%, and 50%. Each level represents a potential area where price could stall or reverse, giving traders a roadmap for possible market reactions. The 61.8% level, known as the golden ratio, is especially significant. Many traders watch for price to bounce or react here before resuming its trend. To use Fibonacci retracement, plot from a recent swing low to the all-time high in an uptrend. This reveals where buyers may step in, providing a visual guide for potential entry points. In a downtrend, draw from the high to the low to find resistance levels. These can signal where sellers might take control, offering potential sell opportunities or places to tighten stops. While these levels aren't magic, they do highlight where price reactions are likely, as many traders watch and act on them, creating self-fulfilling prophecies. The best trades often happen when Fibonacci aligns with other signals, such as moving averages, previous highs or lows, or candlestick patterns. This confluence increases the probability of a successful trade. For the week ahead, use Fibonacci on both long and short-term charts to spot critical battlegrounds. This multi-time frame approach helps you see the bigger picture and fine-tune your entries. Let these levels guide your entries and exits, but always combine them with sound risk management and confirmation from other tools for the best results. The MACD indicator reveals gold's momentum, but right now it's sending mixed signals. On some charts, MACD is neutral to slightly bullish, suggesting patience until a clear crossover. On others, it's bearish, with momentum building to the downside. Use MACD as confirmation, not a standalone signal. Wait for a decisive crossover before acting. This week, a bullish MACD crossover could be the green light for buyers. A deepening bearish signal favors sellers. The stochastic oscillator is a popular technical indicator that measures gold's momentum by comparing a particular closing price to a range of its prices over a certain period. It helps traders gauge the speed and direction of price movements, offering valuable insight into potential market turning points. This tool is especially useful because it warns when the market is overbought or oversold, signaling that a reversal or pause in the current trend could be near. Readings above 80 indicate overbought conditions, meaning gold prices have risen rapidly and may be due for a correction. Recently, gold has hovered in this zone, hinting at a possible pullback as buyers become exhausted. A downward cross from above 80 is a classic sell signal, suggesting that bullish momentum is fading and sellers may soon take control. However, in strong uptrends, the stochastic can remain overbought for extended periods, so it's important not to act on this signal alone. Always look for confirmation from price action, such as candlestick patterns or key resistance levels, before making a trading decision based solely on the stochastic. Bulls should be cautious about entering new long positions at these highs. Waiting for a better entry can help avoid buying at the top. Meanwhile, bears should watch for a cross below 80 to confirm short opportunities, as this often signals a shift in momentum. Remember, the stochastic oscillator is best used for timing your trades, not for predicting the overall direction of the market. For buying, wait for a pullback to a strong support level, ideally when the stochastic is emerging from oversold territory. For selling, look for a rejection at resistance, especially if the stochastic is crossing down from overbought. Patience is key. Let the market show its hand before you act, and use the stochastic oscillator as one tool among many in your trading strategy. Knowing gold's key support and resistance levels is crucial for the week ahead, especially as volatility remains high. Major resistance sits just below $3,500. A break above could target $3,550 or even $3,600 in the coming days. Immediate resistance is in the Rs99, 000 Rs99 350 zone. Support starts at Rs98 300, then Rs98 000, both important for short-term trades. Watch for price reactions at these battlegrounds. Bounces or breaks will reveal the market's next move and possible momentum shifts. Use these levels to plan entries, exits, and stop losses for a more disciplined approach. With the market at a crossroads, two strategies stand out. Bears can sell on rallies to resistance. Look for stalling near Rs99, 150 Rs99, 350, target Rs98, 300 or Rs98, 000, and keep stops above Rs99, 500. Bulls should wait for a confirmed breakout above $3,500 before buying, or use Fibonacci pullbacks to enter near $3,400. Volatility will be high, with central bank meetings and key data releases ahead. Thin trading on holidays could spark erratic moves. Manage risk carefully. Always wait for confirmation from your indicators before trading. Stick to your plan and never risk more than you can afford to lose. In this market, discipline is your best asset.